Hi, this is Randy Finney with the right side of the chart, and this is a closing market wrap for Wednesday, March 27, 2019. Not a big day in the market. It was a down day. Bigger picture, we're just going to start out here. That's what we've been doing for weeks now. Again, we are on the fifth consecutive week of testing that key level. It's about 2,800 on the S&P 500, about 282 or so on SPY, which we're looking at here. And same story, that we had after the Fed announcement last week, the market rallied, thinking low rates are good and going to keep the juices flowing, and then that rally got sold into. So far that's a bull trap. We haven't fallen as impulsively as you want to see. Usually when you have a bull trap or a failed breakout, the reversal is pretty quick. Now we have been reversing since then, so let's take it for what it is. The reversal the following day, I should say, was impulsive that Friday. They faded it hard, but you can see we came back in and again back tested that line. You see as I come in close here. So take what you will of it. The day closed down short, mildly down today, about 0.5% on the S&P 500. But again, it's a continued failure to take out that level, and more so, like I said, sooner or later this level will be resolved one way or another with a definitive break above that recent high from last Thursday or down below this recent trading range, particularly this low right here I'm watching for March 8th. But it's these divergences and everything else that I've covered in recent weeks that still point to a downside resolution of this pattern. So that's that. Until we have either a very impulsive move down intra-week, well below or above these levels, one of those intra-week moves will stick if it's big enough. Otherwise, you want to see a big candle, either a green candle above that high. Now we have, even though this was a level to watch, we do have a reaction high from last week. So the bulls really need to get above that candle now. Bears at the very least, here I'll put a line here, you can start to see, and I'll box it in with my box tool, that seems to be the level. I know I've harped on this reaction low, which is a big one. When that goes, we'll almost certainly, we'll be halfway there or more to my minimum target, and I think it'll open the door down to maybe this, some of these other targets. But first things first, and so what I'm doing here is I added that line right now at about 277.50. You can see as I put that purple line there, that's really contained all the pullback so far since this brief dip down below. So now that's the big level to watch, I think. And a solid intraday break, especially an intraday close, will most likely mean the bears won and we're going to go lower. So let's just move my box right here right now. So those are levels to watch. QQQ, well, let's look at the 60-minute of SPY. Again, I'm going to keep this quick. Same story. We had a divergent high here when we had that last correction. One of the bigger corrections that we've had this year came off that divergent high. Market pushed up, made a marginal new high, but then simply, as you can see down below on the indicators, put in another divergent high, and so far we've been moving back. So that was the post-Fed rally right there, and then the subsequent fade that's really, in a bigger picture, has us right back to resistance. So we can't really say that anybody's won. So still a battleground right there. Trend indicators bearish on SPY. Let's look at QQQ quickly. Same story on QQQ. This is a 60-minute chart. I'll forget about all the lines. Let's just focus right now on the fact that we had a 60-minute divergent high there, correction to this trend line. After the FOMC meeting, a little pop up there, put in another divergent high, and then we broke down below this minor trend line right here. We had a breakdown, back test, and so far a rejection there. Pointed out earlier today in the trading room. Here, I'll show you guys now. This is just general market analysis. We put in a divergent low here. Where did it go? There it is. We put in a divergent low on the 60-minute chart of QQQ. Here, I've got a lot of lines here. So what we're looking at, there's a divergent high. That's the same divergent high I showed you on the 60-minute. But when we zoom down to a 15-minute chart here, you can see we have this bullish falling wedge pattern, nice clean divergent low. I made a comment on the site today for members earlier. We have an active trade on QQQ, so I'm not going to get specific on targets and all that. But in trading, I put a higher weighting on the longer term time frames. In other words, the daily charts take precedent over the 60-minute charts. The weekly charts take precedence over the daily charts. And in this case, the 60-minute charts, we just recently put in this divergent high, broke down and just back tested. So I would suspect more downside to come. And so, a case can be made right here on this 15-minute chart. If I was trading in a vacuum, I'd say, okay, this is very bullish. Let's wait in position long for a breakout here. This would be your measured target, the widest part of the wedge. And if it popped, let's say tomorrow, that would project up to about that previous high. That's roughly the measured target. However, if we do pop it, and this is what I said, I suspect it'll be a failed breakout because of the developments. We have negative divergence, or just put in the divergent high on both the daily and the 60-minute charts. And again, and we have major resistance overhead on the SPY, which was failed recently. So taking all that in, sometimes you have to take a stand. And I also said this, at a lot of points in time, you give me a security, a stock, an ETF, a sector, and if I go through the charts, starting down, let's say to the 5-minute charts, going out to the weeklies, I can usually, not always, but often, quite often, find some bullish developments and chart patterns and technicals, and then some bearish on the other time frames. And again, so when you see that, well, you're going to do one of two things. You're going to have paralysis from analysis if you're making a bullish and bearish case, and or you can decide to put a higher weighting again on the longer term charts, which at this point in time I'm doing. So we'll watch this, and even maybe get another thrust down. I can say this: if it doesn't pan out, let's say we go down or even pop above it tomorrow morning, that's what this market loves, trickery. So maybe it'll want to pop that and get some long sucked in the morning, then reverse it. We might work our way down within this wedge, and this is sort of a support zone, these three lines here, and we could put in another divergent low, just extend those divergences. So it's something worth monitoring for sure. However, if these divergences just fail to play out, whether you get a false breakout or not, and they get burned through, that's pretty darn bearish. That was probably, I imagine there's a decent quantity of active traders that were watching this and are trading and positioning off it, anticipating a breakout. So we'll see. Like I said, technical cross currents, but just like in baseball, tie goes to the runner. It's not so much a case in trading because a tie goes to the longer term time frame in my book. So that's the here's the daily chart, negative divergence on the 60-minute, or I'm sorry, daily chart of QQQ, divergent high, and then I said RSI here. I meant to say PPO. That's PPO divergence right there, negative divergence, just like you had at this point and this point. And that triggered those two corrections. We don't have divergence on the RSI, but we do have an extreme overbought reading there. Last time we were this overbought was back here, and you can see what happened to the market. So would it be great to have divergence too? Sure, but I'll also take that all day long. So again, it's anything's possible, but I can make a clearly a more bearish case on this, as well as the longer term charts and everything else, weekly charts. So that's that. We'll watch those levels, and here's that IWM. I pointed out the divergent low recently in IWM, which has led to a lift so far. But again, in a strong market, in a bull trend, when you get positive divergence on the daily chart, that is a green light, where normally in an uptrend, you don't just play out to the measured target, you keep going. This is what you really want to look for. So this will show us a character of the market. If these divergences don't play out for at least for anything more than this minor bounce, that's a relatively small bounce for such large divergence on the 60-minute chart IWM. If we go lower without going up and taking out this trend line right here, then that just shows you the character of this market, and it shows you that we're probably migrated or have migrated over to a larger bearish trend in IWM and everything else. Okay, and although this is a public video, and typically analysis on anything other than general stock market analysis, that includes treasury bonds, currencies, gold, things like that. That's usually public content, but in this instance here, I'm using this because it definitely ties into my analysis on the broad market. So I want to point out again, we had a what I consider a major breakout in treasury bonds the other day. Let me get rid of that thing right there. That breakout was above this very well defined and significant resistance zone, had one little false breakout attempt, but so far tons of reactions, and another strong day. This is a pretty big move in treasuries. Remember, they don't move as much as stocks or the stock market, so you have a 1% lift. That's a pretty good sized candle, and it also shows follow through. There's some technical cross currents there as well. We have potential divergence, and I always try to do a good job of emphasizing the difference. Again, it's in my book. I don't know if it's elsewhere, if other traders treat it this way. When this divergence would only be confirmed if we have a bearish crossover on the PPO, meaning that orange line crosses the white line, which would effectively put in a lower low. Right now we have a lower low on the RSI, PPO, I'm sorry, right here, but it's still pointed up. And therefore, if it continues up, it will take out that previous reaction high and therefore negate or take out this potential negative divergence. So it's something to monitor, and you have to respect divergences on the daily time frame. They usually lead to pretty good size corrections or trend changes. But again, that being said, the momentum is there. The breakout's certainly valid, even if it were to come back in right now. And that's the thing, it's a little tricky. If TLT did come back in to back test the breakout level around 122.50, and it did it soon, it would confirm that divergence. But then we'd have to weigh out what wins here. The pretty solid, that would be very solid support. It was very strong resistance, so I would expect at least a reaction there to hold. We'll just have to monitor this. I wanted to point that out. And again, bigger picture, since last year, really last quarter, this was my outlook for TLT. I had this yellow bullish falling wedge pattern downtrend line, and I figured we get a breakout here, come up, tag my 122.60 level, which we did, pull back, maybe come in and back test, which we did, and now boom, I don't see a whole lot on this weekly chart of resistance up until about 128.50 or so, which would also coincide with a back test of this trend line that was broken right here. So what I'm seeing, if this continues to play out, what it's telling me now, two things. There's undoubtedly two things when treasuries rally. Either a flight to safety from institutions, meaning they're pulling money out of stocks or hedging up, putting money into the safe haven asset of treasury bonds, and or slowing growth expectations for the economy. So they go hand in hand. Neither of the two are good for the stock market. So either this is going to be a one-off thing and that breakout's going to fail, and I can tell you with a very high degree of confidence, if that is the case, if this breakout in treasuries fails and moves down, it will only because the stock market's about to rip. I don't think either are going to happen, but if it does, if you start to see the stock market rally come up at those highs from last week and treasuries dropping, this could prove to be a giant fake out. As of now, I'm taking it on face value, and this is indicating, it's a red flag for stocks, that's all. One other thing giving me pause, speaking of bonds, I don't only follow treasuries, I also follow the other end of the spectrum, which is the junk bond market. This is JNK, the junk bond ETF. You can see all the divergent high right here. Here's a key trend line, downtrend line right here. I'm watching, and we're pretty much at it. It's, this won't track perfectly. You have a lot of dividend payments and whatnot. We're slightly above it, but not an impulsive breakout. And I probably should look at HYG too. That's the other one. Draw a trend line there. Let's see if we can do that. Yeah, it's poking its head above, so maybe that will prove to be the real deal, maybe a false breakout. It's not impulsive. But more importantly, when I come down to the daily time frame here and I look at the action, this isn't meshing with the recent weakness in equities right here. Junk bonds, of all bond classes, you have different types: corporates, junk bonds, muni bonds, treasuries. Junk bonds are the only ones that trade much more closely with the stock market and economy than they do with interest rates, because although they are somewhat rate sensitive, treasuries are much more rate sensitive. Junk bonds, the biggest determination in price, if you will, is how safe the credit quality of the issuers are. All these companies they're called junk bonds for a reason. Obviously, because their credit quality is subpar, and if the economy starts to turn down, if you even are coming close to or in a recession, the default rates tend to spike. So therefore, it doesn't matter if they're yielding 6, 7%, 8% interest, whatever it is. If you have 20% of the companies in there go default and not pay you back principal, you're not only not going to earn that 8% or so return that you bought this junk bond fund for, you're going to lose a lot of principal. So that's why they're much more sensitive to the economic cycle than they are to the interest rate cycle. So Why are they going up? I don't know. That's one thing giving me pause right here. But we'll watch this. If they start to turn down, I can say this: in recent years, a lot of the junk bonds are from companies in the energy sector and exploration production companies, frackers, things like that. Crude has been up recently, which has given that sector a boost. So that's something you also want to keep an eye on. And finally, to wrap it up here, let's go to Fred. This is what I watch. In addition to junk bonds, you can easily glance at that and see what's going on. I like to watch credit spreads, which are another way to look at the junk bond or high yield market, and that's what I'm looking at here. And this chart over the years has given me some clues to some pretty big corrections. Last time was back in 2015. What you're looking at, you can see the scale up here. This is the Bank of America Merrill Lynch US High Yield Master 2 Option Adjusted Spreads. Basically the spread between safe treasuries and high yield junk, aka junk bonds. So that's what we're looking at in blue. When that goes up, it means that you're paying the junk bonds are having to pay a much higher interest rate because there's a lot more risk being priced into those. So a much higher rate compared again to treasuries, which are the opposite end of the spectrum. So not good when you see this rising. And so what I'll do is I'll look for divergences and things like that. When you see the stock market rising along with credit spreads, then that's not a good sign. So right here you can see where were we going back? The red line's the stock market. So remember back in 2015, we had a nearly 2-year bear market. We went sideways or I should say, a sideways market with a couple big corrections in there. And the tell was back here, and I pointed out on the site at the time, we had credit spreads rising along with equity prices. Not good. So what happened is we had a little shot across the bow here. Stock market came in. Then credit started to rally again, credit spreads abated, but then they started creeping up again. You can see that they were creeping up, and the stock market ignored it until it finally, I don't want to call it a crash, but it was nearly a crash. That was a 15% or so, very swift drop. We had another leg down afterwards, and you can see credit spreads spike. So where are we at today? Let's just come forward. Come forward. There you go. So now you can see the scale down here. So we had at this point, see this time around it caught a lot of people off guard, and this is only one of many things I look at. This wasn't flashing any red signs, but however, back on the site we clearly identified when the top was coming. We even knew, pinpointed it down to the breakdown in the NASDAQ 100 and the tech stocks XLK. I was hyper focused on the tech sector back then and the FANG stocks. So we were able to get in early around that correction, and I figured it would be a big one. And again, so this shows you that there's nothing in trading that's 100%, because I know over the years, I'm not the only one that watches this. A lot of professional traders watch it. There were no warning signs from the credit market. So just keep that in mind back then. Yet there's a stock market top, and it took it on the chin. You can see then credit spread spiked. However, what they've done is they really haven't abated back to the pre-Q, call that the Q4 correction levels. You can see right here when I zoom back out, again, focus on this blue line above. That's where credit spreads bottom. Again, they didn't see this coming, but they certainly reacted to it with a big surge. But look where they are now. They're well above this range right here. So they've come back and they've started to creep up, and that's similar to what happened right here. Remember, this is where the big drop started back in 2015. You had that initial leg up, like we had right here and here. Then it abated. It's like that, shot across the bow or close call. So the market's like, whoosh, close call. Everything's okay because credit spreads are falling again. Well, no, they fell, but they didn't return back to their lows, and then they shot up again. So we'll watch this. This may now keep an eye on this. It may show us what's about to happen in the market. If everything's hunky-dory and all this talk about a recession coming down the pike, it just proves to be fleeting and it's a scare and the economy picks back up, then you should see credit spreads abate and of course stocks go up. Otherwise, right now, where we're at, looking at this chart, I'd say the market's in a precarious position, so keep an eye on this if nothing else, and also watch junk bonds. Again, I don't know the composure right now of JNK. I'll have to dig down in it, and I do know that there's a lot of energy stocks that are holding it up, and I don't know the complete. But this, if you're going to watch one of the two, I would put more emphasis on this chart here than I would on JNK, the junk bond ETF. And that's about it. All right, we'll see what happens tomorrow. But as of now, I give you those levels going back to the S&P 500. Let's watch that range, and another down day. At the end of the day, we want to play the game where you say today the Bulls won, today the Bears, yesterday the Bulls won, or today Bulls, Bears, whoever. I think you know where I'm going. Then you have to say today, undoubtedly the Bears won because they parked it red, and QQQ was down 0.64%, by the way, and another down day in IWM, financials, everything else. So we'll keep an eye on it, and I'll pick this up tomorrow. This has been Randy Finney with Right Side of the Chart. I hope you enjoyed it.